Welcome to episode 11 of Insider Investing. On this episode, we cover a very interesting topic which affects all our personal finances and investments, which is taxation. Over the last 15 or 16 years, Vaibhav and I have worked with the ultra wealthy and absorbed certain best practices when it comes to how they optimize taxes when it comes to their portfolios and their income. One of the most interesting things we cover on this topic is the new changes on taxation when it comes to crypto, the concept of tax loss harvesting, and how we can use deferment to our advantage to optimize our taxes. Hi Vaibhav, welcome back to episode 11 of Insider Investing. There's one thing that I realized earlier today, and today is we're recording this on 13th of March. It's a Sunday, and I realized that I haven't figured out my advance taxes for the year. And it's that sinking feeling that you get because now you have to figure out how to get the money to pay the tax. And I feel every year that I could have been a little smarter about my tax planning. Having advised a lot of HNIs in the past, I feel that potentially all of us are not as on the ball on our taxes as the ultra wealthy are. And today, I thought it will be good for us to cover the best practices. What are the things that we should be thinking about? We all know that you are a chartered accountant ranker. I am not. I've just done finance and strategy. But I think it's important also for me to say right at the top of this show that all that we discuss here is not specific tax advice. It is our learnings from having dealt with high net worth individuals about how they manage their taxes. So, what I would strongly encourage is each one of us to consult our own tax advisors before we act on this. That said, Vaibhav, welcome back again to the show.
Thanks, Sandeep.
What is the one big thing that you feel that the wealthy do when it comes to taxes, but that each one of us don't?
Interesting question, Sandeep, and it's a season of taxation. Every where I go, I read about investing in equity-linked saving schemes to save taxes. We get enough number of calls from different advisors who are advising on investing in tax planning instruments. To your point on what high net worth individuals do versus what most of the other investors do is to focus on two things. A, they convert their income largely into capital gains, and capital gains have preferred tax treatment versus any other category of income. And B, they don't pay taxes very frequently, and maybe in the subsequent part of this podcast we can touch upon both of these points.
Yeah, I think what you mean by that is that they pay taxes, but they plan for their taxes. I think let's go a little deeper in that and let's think of taxation at two
Yeah,
levels. One is when we earn an income from our core profession,
yeah,
salary, and other things.
yeah,
And then the second stage of taxation occurs when we have invested that money
yeah,
and we get gains out of
yeah,
it. So let's first focus on the sources of income,
yeah.
and let's begin with what most of us have as a primary source of income, which is our salary. How do you think we should be thinking about optimizing our salary or tax on the salary income?
So it's a great point, Sandeep, and unfortunately, all of us know that there are very few avenues available to save taxes because your deductions are restricted in a large way. Select deductions are allowed, nothing beyond that. But look at it from government's perspective, and that will possibly help our users better in deciding how they should plan their taxes. What government is telling you when you earn salary income is to give you deductions on two accounts. Either you help in capital formation, okay, that you can do by investing in select investment schemes, and making these investments will allow you to save taxes. Or certain
Hmm.
nature of expenses which are unavoidable and critical for the assessee. If you spend money on those expenses, government will give you deduction on taxes. So broadly, you can classify tax planning tools in two parts: investment
Hmm.
related tools and expense related tools. In investment related tools, if you invest in equity linked saving schemes, so which means you're contributing to capital formation in equity, that will give you a benefit of deduction. If you invest in fixed income schemes which are promoted by government in form of EPFO or NPS, where you're investing money for long term and helping government mobilize resources for the growth of country, there you get benefit on taxes. Or on expense side, where you have some critical expenses which you are incurring, whether it is education of your child, which again is important on the development of skill side, or you are spending money on any kind of potential liability which may occur to you in terms of health insurance, in terms of life insurance. So that's how the government is looking at it, and that will possibly help our users better in deciding which way they want to move.
Yeah, I think that's a great framework, Vaibhav. One is you said that there are certain tax benefits that you get on account of doing the right investments, and the second is by capturing some of your expenses correctly.
Yeah,
I think expenses, like you said, are typically the unavoidable ones. You won't incur an expense just to save
yeah,
tax.
absolutely.
Uh, yeah, but on the other hand, in the first category, which is the category of investments, there is a lot of optimization to be done. We have written about this in the past, where this whole thing that ELSs are always right for you is a question that needs to be asked. There are some cases where each one of us have a part of our allocation to fixed income, and their income returns from the PF schemes are potentially better on a net of tax basis than what I would get from other fixed income opportunities.
Yeah.
Therefore, it may be important to prioritize fixed income investing out of this pool as opposed to equity investing out of the tax savings pool. What do you think of that, Weber?
No, that's an important point, Sandeep, and I'd also thought about it when you and today is a great day to have this conversation where I read this article that government has reduced the rates to 8.1%, but 8.1% post tax in an era where FD returns are down to 4.5% is a great alternate to any fixed income instrument, especially because it comes with Government of India guarantee. They're not taking any kind of risk and still generating 8.1% post tax returns. We discussed this in the past that in equity, the return differential between ELSS schemes and normal equity schemes is negligible or not there. But in case of fixed income instrument, the return differential itself is large enough for you to consider EPFO over ELSS in select cases. So that's the framework with which I think our investors should think. In case they have limited capital, they want to optimize that for long term, then obviously equity is the better asset class. But in case they have reasonable amount of capital where they have ability to allocate money across asset classes, priority when it comes to tax planning instruments should be given to fixed income.
Correct, absolutely, and that's a very helpful construct for each one of us to be aware, especially as we are in the last 10, 15 days of this financial year to make that investment. The other point is now let's focus on another type of income that we get at the top before we get into the investment tax understanding, which is the income that we get on account of ESOPs. Now, the interesting thing is that very few people know that you get quote unquote deemed income, or income is assumed to have been arisen the moment you exercise ESOPs.
Yeah,
Uh, and that's a very strange concept. We were having this conversation in our office when one of our colleagues was exercising her ESOPs from a previous company,
yeah.
and she was not able to reconcile the fact that she has to pay tax on that. And the most interesting part is uh, that some most of the times this tax outgo is much more than what you're paying to buy the ESOPs.
Yeah, yeah.
Let's explain this concept of perquisite tax, Vaibhav, because I think it is an underestimated part of the gains that you get from ESOPs.
Yeah, great point, Sandeep. And all of us have gone through that heartache of paying disproportionate taxes on ESOP exercise. Uh, what government here is trying to say is that if you have got your ESOPs at certain price and today's fair value is significantly higher than your strike price, then the difference between the two should be deemed as perquisite. You are getting
Hmm.
that benefit because you work for the company, and because that expense is deductible for the company, the recipient of ESOP benefit should be paying tax on that income. So let's build on this through an example. uh, if you get shares of a company, ESOPs of a company at 10 rupees, okay,
Hmm.
at the point of exercise, if the fair value of the stock has gone up from 10 rupees to 100 rupees, and 90 rupees is a benefit that company is giving to an employee. Against that benefit, company is claiming expenses in their profit and loss account. Now, government is saying we can't lose taxes at both the ends. If company is claiming expenses, then someone has to pay tax on this income. So, therefore,
Hmm.
the beneficiary, which in this case is employee, is expected to pay tax on this notional gain of 90 rupees. Now, why I'm calling it notional is because in most of the cases, employees choose not to liquidate the either they choose not to liquidate or they don't have any liquidity in the stock of the company where they can get realization of
Correct.
uh, the stock.
Yeah, absolutely. So, this is an interesting point. Imagine a situation where, like the example that you gave, I have invested 10 rupees to get this stock. I have got stock worth 100 rupees. So, on the 90 rupees, let's assume we pay tax of 30%. So, 27 rupees goes out as tax.
Yeah,
So, I have paid not only the 10 rupees, but also 27 rupees. So, outgo from my side is close to 37 rupees. Okay. Now, while I've got stock worth 100, your point is that if that stock is not saleable,
yeah.
if I'm not able to liquidate the stock, how do I pay for the 37 rupees which I had to pay for getting these options? And which is why one of the clear things that we see as a behavior among smarter people who understand ESOPs is that they exercise ESOPs only when A, either there's a liquidity, or second, where the ESOP is about to lapse and you cannot exercise it after a certain date and you don't have a choice, that is the time you exercise ESOPs. And the other point is also, then you were referring to this when you talked about how the wealthy manage this, is that they defer the tax as much as possible. And
Absolutely.
the same thing with ESOPs. You exercise the ESOPs as late as possible unless one of the two situations arises, which is A, there's a liquidity event happening, your company is up for sale, the stock is listed, so you can transact on the stock, or there is a buyback or some such event is happening. So, either in that situation, or if I have left the company or my vesting period is coming to an end, and I don't have a choice but to exercise it.
Yeah. There also you will exercise only if you see meaningful upside. You will have to do cost benefit analysis. So in this given example, uh,
Yeah,
you are paying 37 rupees where the fair market value is 100. It makes sense to exercise. But
yeah,
imagine a scenario where your exercise price is 10 rupees and fair market value is 20 rupees. It may not be
correct.
beneficial to exercise. So each
Absolutely.
scenario should be evaluated on a standalone basis depending on the details of the situation.
Yeah, and the last point on this perquisites amount is that this gain of 90 rupees gets added to your regular income in that year and can has the potential of changing the tax slab for your entire income.
Yeah, yeah,
So you might have a situation where, and as we know that at different slabs the surcharges change or the tax rates change, and after a certain point the surcharges
yeah,
change, right? So you, as your income level goes higher, you pay a higher amount, higher percentage of tax.
Yeah.
If because of the exercise of ESOPs, you have a larger perquisites tax, you end up in a situation where on your overall pool, you are ending up paying a higher amount of tax. And this is something which causes a lot of heartache, especially when going back to the point that you don't realize this income.
Yeah.
You are not getting the income, and yet you have to pay tax. You have to pay a higher rate of tax on your other income just because this happened. So the ESOP taxation is a conundrum of its own.
Yeah. No, government is becoming sensitive to this, and they've allowed certain startups to defer taxes at the point of
Yes.
sale. So, which is a positive step. I'm hoping that sooner or later, government will allow all the companies or all the employees to defer their taxes.
Yeah, we'll be strong proponents of that because for our employees, for all the startups in the ecosystem and India as a startup economy, I think that will be a huge, huge positive. Vaibhav, now let's switch gears to the investing side. Uh, and this is something that you and I have seen very, very closely. That when it comes to their money, the ultra wealthy factor in taxes in a major way when deciding where to invest.
Yeah.
Taxes don't guide the investment necessarily by themselves, but they are an important factor in that. And one of the biggest focus areas that I've seen the HNIs work on is the concept of tax deferment.
Yeah.
That you will pay tax only when as late as possible.
Yeah.
Let's talk about this a little bit in the context of how taxes are paid in India on the capital gain side.
So let me explain this with an example. So let's take a scenario of two portfolios. Now, one
Hmm.
portfolio is managed directly by an investor, and second portfolio is managed through a mutual fund scheme where you have an option to postpone your tax liability. In one case, let's say in both the cases, you start with 100 rupees. After 1 year, you have generated a gain of 20 rupees in both these portfolios. In first case, you decide to book the profits to move into other stocks because you believe that
Hmm.
you realized maximum potential from this investment. You should change the composition of the portfolio. The moment you do that, you are subject to tax liability on the gains of 20 rupees, which, if I take an ideal scenario, will be a 12% tax or 11% tax, including surcharge on long term capital gain. Or a most likely case would be a 13-14% tax because some of the transactions would be short term in nature. So end
Mm-hmm.
up paying 13 to 14% tax on a gain of 20 rupees. So that means your capital, which is available to grow in the next year, goes down from 120 rupees to 117 rupees.
Correct.
In the second case, when you have invested the same amount through a mutual fund scheme, fund manager gets this feeling that he needs to change the portfolio. He will change that portfolio within the scheme without you having to pay any tax. And
Yeah.
because, as all of us know, that mutual funds on their internal transactions is not subject to pay any taxes, there is no drop in the deployed capital for investors who invest through mutual fund. If you keep running this cycle year after year over a
Hmm.
10-year period, there can be a difference of 1.5-2% per annum on returns purely on account of ability to defer the taxes. So 18%
Hmm.
tax versus 18% return versus 20% return can be a outcome. And
Hmm.
over a long
Yeah.
period of time, 2% compounded year after year can have a difference of 40-50% on your initial investment capital. So that's how investors think about deferment. Your objective is to maintain the dynamism without necessarily having to pay taxes at regular interval.
I think this is a very important point, and I think it arises from one concept of taxation, uh, which is that when it comes to capital gains or investment gains, taxes are paid only when the income is booked, as opposed to on the value of the asset going up.
Yeah.
At least for individual investors, people like you and me, if my portfolio goes from 100 to 110, we don't have to pay tax on the 10 rupees unless and until we book those gains or we sell those instruments to get the profit in our
Yeah.
account. And which is why sometimes there is this concept of periodic booking of gains. It is a psychological comfort that you get. You might actually be worse off from a tax perspective because you are paying taxes much earlier than you need to. Now, when it comes to mutual fund, and you gave an excellent example on direct equity investing versus mutual fund investing in equities, where the taxes need to be paid in case of mutual funds when you exit the mutual fund 1 or 2 or 3 years later. Whereas in case of stocks, if you're trading on the stock portfolio, you will pay tax on a year on year basis. The difference is actually, Weber, far more acute when it comes to fixed income or debt mutual funds or debt investing. In case of debt funds or debt things like bonds, fixed deposits, etc., you are paying tax practically on a monthly or a quarterly basis because that income is getting booked in your hands on a monthly or a quarterly basis when it comes to fixed deposits. But when it comes to mutual funds, if you're invested in the fund for say 1 or 2 years, you are paying tax only when you sell out on the units of the fund. So you're deferring your tax from a quarter on quarter basis to maybe 2 or 3 years later. And the last thing is that the magic of the tax rates. When it comes to debt mutual funds, more than 3 years, you get taxed at a lower rate and you are able to get the benefit of indexation. So on the debt side, and maybe Vaibhav, you can illustrate this better. On the debt side, the gap is actually much higher than it is on the equity side.
No, it's a great point, Sandeep. And fixed income investing is something which signifies the point of tax paid by wealthy individuals versus people like us to the maximum levels. I've yet to come across a high net worth investor who keeps money in fixed deposits of bank, because they understand the fact that when they keep money in interest bearing instrument, they have to pay tax at marginal rate of tax. The moment they use mutual fund as a platform or as a vehicle, they can convert that interest income into a capital gain, and government
Hmm.
is far more sympathetic to capital gains versus interest income. So again, let me use an example to simplify it for our listeners. So imagine you have 100 rupee to invest. You invest in a bank FD at 6% rate of interest. Every year you will get payout of that interest. Income tax recognizes that income as income of current financial year. The moment you realize that return, you have to pay, or even if you don't realize that return, you have to pay tax on accrual basis. So, in case you invested money for 9 months, basis 9 months, you'll have to pay tax on
Tax.
that income. So, if you have invested 100 rupees, if you generate 6 rupees on that, you pay tax. Let's for a moment take 30% as rate of tax. Your return after tax will go down to 4.2%.
Mm-hmm.
Again, the same logic of no deferment. Next year, starting with a base of 104.2, and you are generating 6% on that. Again, you will pay tax, and once you complete a cycle of 3 years, you will have about 114 rupees as your net of tax returns in hand. Now,
Mm-hmm.
imagine you invest the same money into mutual funds and take 3 years as holding period, and instead of receiving your income in form of interest income, you receive your income at maturity in form of capital gains. There are two advantages. One, there is deferment, because as you mentioned, you pay taxes only when you realize your income. B, you get a
Mm-hmm.
benefit on account of indexation. Indexation is
Correct.
nothing but government is giving you relief to the extent inflation is prevalent or impacting your value of money.
Mm-hmm.
So, using the same example, if you are generating 6% in debt mutual fund for 3 year, but because inflation is 5% average for
Mm-hmm.
3 years, year after year, you will be paying tax only on 1% return, and that too at a subsidized rate of 20%. In the same example, if you invest money in the same bank instrument using mutual fund as a platform, after 3 years, instead of 113 in the first example, net of tax, the money which you will receive in hand will be 117 and half. So the difference is
Wow.
3.5-4% over your investment tenure, which becomes larger and larger as you keep increasing your investment tenure.
Yeah, it's a very interesting point, 3.5, 4%. But on one hand, you had 113, and on the other hand, you had 117. So you've actually made 4 rupees extra on a base of 13. You are potentially making 30% higher gains
Yeah, absolutely.
than you would have done in case of fixed deposits. And you're absolutely right. Rarely ever have we come across an ultra wealthy individual who has kept money in fixed deposits. They're always preferring mutual funds on that side. And the same thing applies in case of stocks. Stocks versus mutual fund equity investing, mutual fund equity investing ends up scoring above stocks for this very reason. Now let me go back to one major asset class which seems to be getting everyone's attention, and obviously we are waiting for the regulators to bless it as a regulated instrument to be able to invest in. But as a digital asset now, the current budget recognized crypto, and for the first time starting 1st April, these will be taxed in a different manner.
Yeah.
Uh, Vaibhav, explain to everyone the concept of taxation when it comes to the TDS element and when it comes to how when the gains are booked on crypto assets.
Sure. So first, let me cover the TDS part. Government wants to bring income which is generated by crypto investors under the ambit of tax, and therefore they have
Mm-hmm.
introduced the concept of tax deduction at source. So every time you will sell your crypto positions, the exchange through which you are trading will have to deduct TDS at the rate of 1%. That
Mm-hmm.
1% allows government to capture your transaction in your annual income statement. On the taxation side, government is obviously there are a lot of ambiguities which needs clarity from the regulators in terms of what will be the treatment of the outstanding gains on 31st March. For example, if you bought a Bitcoin at $1,000 on 31st March, the price is 38,000. Do we still have to pay gains taxation from 1,000, or will have to pay taxes from 38,000 onwards? Is yet to be clarified by the government. But on a fundamental basis, what government is saying is the treatment of taxes will be very similar to how government treats taxation on lottery or speculative gains, where
Mm-hmm.
you pay flat 30% tax on gain regardless of your income tax slab. So even
Mm-hmm.
if on your normal income you are paying no tax or 5% tax or 10% tax, you'll still have to pay 30% tax on your gains from crypto investing. Second,
Mm-hmm.
you won't be able to carry forward any losses.
Mm-hmm.
Third, you won't be able to offset your gains in crypto against losses in any other asset class. So
Mm-hmm.
typically, as you know, we can offset intra categories or inter categories gains and losses. But in this
Mm-hmm.
case, offsetting will be allowed only within the same segment, that too within the same year. So if you
Mm-hmm.
have profits on Ethereum and losses on Bitcoin in the same financial year, you'll be able to offset. However,
Mm-hmm.
in case your gains in Bitcoins have got realized in this financial year, whereas your losses in Ethereum are getting realized in the next financial year, you won't be able to offset that. So government
Yeah.
is very clear that they want to bring in this income under the ambit of tax, and also has introduced an extremely tough tax regime for this asset class.
Yeah, and therefore it's very important for those of our listeners who are investing in crypto assets to now have the right tax advice when it comes to this part of their portfolio. And I am sure that the chartered accounting community will come up to the challenge and they will understand the taxation. Because as I read somewhere recently, nearly 1 crore investors in India have taken exposure
Yeah.
to crypto assets, which means a lot of more work for chartered accountants all over the country. The last part, Vaibhav, and this is something that we hear in popular discussion, is this concept of tax loss harvesting.
Yeah.
And while it's not our place to recommend for or against it, it's important to understand what it is and why people do it. And maybe I think, especially in a time when this quarter, as we speak, a lot of stock portfolios are down. Uh, let's go a little deeper into understanding what is tax loss harvesting, whether right or wrong, why do some investors do it?
There are two ways in which typically tax planning or tax optimization can be done. Let's not use the word planning because people may perceive it negatively, but tax optimization can be done. So, first is up to 1 lakh rupees of long term capital gain. There is no tax incidence. Okay.
Correct.
So, we recommend all our investors that if they are sitting on gains, and they've not booked any gains in the current financial year, at least up to an extent of 1 lakh rupees, they should book gains so that it becomes exempt from any kind of tax. Second, in case you are sitting on losses, you can book those losses today and carry forward these losses for a period of 8 years to offset against any potential future gains. So, which is exactly what tax loss harvesting is. You enter into a transaction today to carry forward tax capital losses in your balance sheet for a period of 8 years, which you can utilize to offset your future tax liability.
Yeah. And the important thing, however, to know is that this is not as easy
Hmm.
to execute as it sounds. If I have one stock which is sitting in a loss, I sell it to book a loss with the view that I will buy it back. What I often see is that investors don't end up buying it back instantly. You end up buying it back either a few days later. You want to stagger your purchase. All of that confusion happens, and sometimes you miss the big picture that you wanted to hold the stock in the first place for long term gains. So I think important to be aware of the concept of tax loss harvesting, but certainly not it doesn't probably work for everyone that we know.
Absolutely, and I would prefer the first approach over the second one, where at least to an extent of 1 lakh rupees, you save
Yeah.
taxes.
Yeah. No, this is very helpful, Vaibhav. I think from for me, two big takeaways. One, that each one of us needs high quality tax advice to ensure that our portfolios we are not paying extra tax, and also even at the top when it comes to our income, we are handling our taxes better. The second, and that's an equally important takeaway for me, is that how much do investment professionals, advisors, wealth managers, distributors need to know about taxation? Because to be able to recommend the right set of instruments to your client, you need to know how taxes work. And on that note, thank you, Vaibhav, again, and we look forward to doing this again very soon.
Great, great. Thanks a lot, Sandeep.
We hope you found the insights from this show useful. You can subscribe to the show on your favorite podcasting platform. Also, follow the YouTube channel of Dezerv for more insights on personal finance and investing.